Hello, hello, hello. Good afternoon. Jeremiah Conjure here from Annuity Association, and I'm back again for another unbiased independent annuity review. Today we're going to be discussing the Power Select Plus Income fixed indexed annuity offered by AIG. If you haven't watched our other review we just did the other day, it's another Power Select Builder series from AIG. It was on the growth side of their fixed indexed annuity lineup. And this one that we're going to be talking about today is all centered around lifetime income. So there's going to be a couple options that we're going to take a look at on how you can generate a guaranteed lifetime income stream. We're also going to be diving into how using this type of annuity for lifetime income also allows you to maintain liquidity over your original principal investment by using the index strategies to try to grow it and keep up with the markets and that sort of thing. So I hope that you're going to get some value from this. In addition, we'll be diving into the unique features and benefits, as well as taking a look at a sample illustration on how the lifetime income can look for you in the future. So before we get started, I'm going to go ahead and pull up our handy dandy disclaimer. We'll get started with that. And once we get this fun stuff out of the way, we'll dive right in. So today we're reviewing the AIG Power Select Plus Income Fixed Indexed Annuity. This is an independent review by Annuity Association. This is a review, not a recommendation to buy or sell an annuity. AIG has not endorsed this review in any way, nor do we receive any compensation for this review. This review is meant to be an independent review at the request of website visitors so they can see our perspective when breaking down the positives and negatives of this particular annuity. Before purchasing any investment product, be sure to do your own due diligence and consult a properly licensed professional should you have specific questions as they relate to your individual circumstances. All names, marks, and materials used for this review are property of their respective owners and not that of AnnuityAssociation.com. While care has been made to ensure this review is complete and accurate, no guarantees are made to the completeness or accuracy. All right, so thanks for bearing with me through that. That's the most difficult part of the entire review process here. I promise I'm going to try to make this more of an enjoyable experience for you. I'd like to say first and foremost that I'm really enjoying doing these reviews for people out there. The feedback that we've received has been just super positive. People are loving the way that we're breaking down the ins and outs of each annuity, comparing them to the rest of the general marketplace, and really identifying, or rather helping you as a consumer identify with each individual annuity on whether it's a right fit for you or a good fit for you in the future. So that is really the goal and the premise of us doing these reviews, is to really help the end user, the end consumer, make an educated and informed decision on whether or not an annuity is right for them. And then if so, which type of annuity, and then which one of that type is going to offer them the best economic benefit for their individual needs and circumstances. So if you're interested in getting a free annuity comparison report or an annuity rates report, you can visit our website at AnnuityAssociation.com. Right there on the main page, fill out the form, click the green button to request your free report, and we'll get that sent out to you in a timely fashion. So, okay, without further ado, let's go ahead and dive in. I'm going to share my screen and we will go right into the brochure. So today is all about AIG and their index annuity lineup. We're going to be specifically speaking about the lifetime income focused product, which is called the Power Select Plus Income. And it's all about utilizing a fixed indexed annuity to do a few important things. That is to help us grow and protect our nest egg, as well as be able to use it to generate lifetime income. So they've got some beautiful pictures of a retirement couple driving down the road off into the sunset. And, I think that's what we're all dreaming of when we're thinking about retirement. But it's really about the decisions that we make today, or lack thereof, on whether or not we get to fulfill our vision. So our vision of retirement can all be different, but at the end of the day, I think we all want to be happy. And, unfortunately, money is part of that equation most of the time, because in order to do the things that we love, spend the time that we want to with our loved ones. We need to have the means to be able to do that. So it can be as exciting as traveling the world or as quiet and relaxing as spending a day on the beach. To help secure the retirement lifestyle you want, it's important to find an accumulation and income solution that can help you overcome today's key retirement challenges. There's no question about it that we're in low interest rate environment, probably some of the most historic lows of all time. In addition, markets are volatile than ever, although we have been through a very strong bull run. What all things that go up must come down. At least I think that's the saying that I've heard in the past. And then in addition to that, you couple those two things with longer life expectancies. It's really making retirement and retirement planning very challenging. So whenever you're building a plan, I always look at it as I use the analogy of it's like building a house. You have to build a solid foundation first and foremost. And in retirement, that foundation is income. And once you have a solid income foundation, then you can build the rest of that plan to do those, things that you are wanting to do in retirement. But first and foremost, your priority should be securing your nest egg. I think we all agree that as we age, we must be more conservative with our money. And in addition, we need to be able to generate income and do so in the most efficient manner possible. And a fixed indexed annuity built for lifetime income is designed just for that purpose. So the Power Select Plus from AIG is a fixed indexed annuity built for powerful accumulation as well as providing income solutions. The Power series of index annuities are fixed indexed annuities that offer a valuable combination of tax-deferred growth potential, principal protection, and guaranteed income for life. This blend of accumulation and income features may be the solution to achieving the retirement you envision. The Power series of index annuities can help you overcome today's key retirement challenges that we just mentioned. Also help you grow your retirement assets, whether you're leading up to retirement or maybe you've just recently retired or find yourself a few years into retirement. Regardless, safe growth is really what I think we all are really striving for during our retirement years. And with low interest rate environments and, our traditional safe money instruments that we used to go to, like bank CDs, money markets, and bonds, with those no longer providing enough yield to even keep up with inflation, fixed indexed annuities have become that new alternative that really have, pack a powerful punch, but do so in a very safe, conservative manner. It's also designed to protect your principal from market downturns and obviously guarantee more income for life. So we talked about the key retirement challenges, but let's dive into those a little bit more in detail. Low interest rates may make it difficult to produce the income you need in retirement. Given today's CD and treasury yields of, anywhere from 50 basis points to 1.9%, you would need to place $1 million into these fixed income instruments to generate interest income of just $5,000 to $19,000 per year. And according to a survey done, I guess this was back in 2019, obviously rates were a little bit higher back then than they are 2020 and leading into 2021. The average 1-year CD rate was 0.5%. And then the 10-year treasury yield was 1.9. Today, I just took a look at the treasury yield today for the 10-year treasury, and I think it was like 1.14, if I remember correctly. So obviously much lower than it was in 2019. And if you look at the Fed and what they're communicating is that these low interest rate environments are going to be this way for years to come. And one of the things that we need to really be proactive about is making the right decision today to at least put our money in a vehicle that can give us a yield at least minimum higher than 2 or 3%, because that's what inflation's about at this point, and maybe higher in the future because of all the money that's recently been printed. Market downturns, a bear market can significantly impact the value of your retirement assets. When it comes to planning or executing your retirement accumulation strategy, consider financial instruments that can protect your portfolio from loss of 20% or more in an unexpected market downturn. Here they have a statistic on the right. An average of once every 3.8 years, the stock market declines of 20% or more since 1900. So that's a pretty alarming stat. That's from the source of Ned Davis Research Incorporated, and it's based on the Dow Jones Industrial Average. Daily closes from January 2nd of 1900 through December 31st of 2019. So average of once every 3.8 years, the stock market declines of 20% or more since 1900. I think that really tells us that we need to really consider, how we can protect our nest egg from those declines, because as you get into retirement, you obviously retire your income paycheck as well. So when you're in retirement, you no longer have bounce back and time on your side. You're no longer contributing to your retirement accounts because that income is gone. And now you're relying on that nest egg to provide income. So it has the adverse effect where, when you're going through your working years, when the market drops, you just buy more shares of stock at a lower pricing. And over time, when the market rebounds, you have a higher overall average, return. But when you're in retirement, because you're no longer contributing to your retirement accounts and have the ability to buy stocks at lower price points, now, if you are still in the market, you experience that loss or realize that loss because you're selling stocks at a downturn, at a lower point than maybe what you bought them at to produce income. So that's why maybe the stock market, if you have a lower risk tolerance than the average person that's still working, chances are you don't want to be in the market during those downturns, and a fixed indexed annuity could be a suitable alternative for you to help you generate income and shield your assets. Living longer, it's simple math. The longer you live, the more assets you'll need to accumulate for retirement. Building your retirement savings is important, since retirement for you and your spouse may last 30 years or more. Here's an interesting statistic on the right: 50% chance that one spouse will live to age 93. That comes directly from the Society of Actuaries, a 2012 study of an individual annuitant mortality table for a couple of age 65. So 50% chance that at least one of those spouses, age 65 or younger, will live to be age 93. So that means we have to have more money, or we need to protect our money to make sure it lasts. That's where the value from the protections of a fixed index annuity come into play, as well as lifetime income that's guaranteed as long as you live. So considering an indexed annuity to help overcome the challenges, a well-balanced retirement portfolio may include a range of conservative, moderate, and aggressive instruments. When building a portfolio to meet your individual needs, consider the following retirement savings pyramid. Vehicles like stocks and bonds may offer strong return opportunities, but they lack protection guarantees and are subject to higher risks than many annuities or traditional fixed income solutions. Allocating assets to a versatile, conservative instrument like a Power Series index annuity may provide the growth potential you need to help combat low interest rates, as well as give the guarantees you want to protect your principal in volatile markets and bring the certainty you desire to ensure you won't outlive your money. So here's that pyramid they're referring to. And I really like this picture because it breaks down all of the different financial products that are available to you as a consumer. And it breaks them down into, conservative, moderate, and aggressive. Now, you'll notice stocks obviously being the most aggressive. When you're in the stock market, that's that risk-reward relationship. So, in order to have a higher reward, you're going to have to take a higher risk. And as you go down the pyramid, you see bonds are in the middle at moderate. Now, the reason why bonds are still in there at moderate risk is because there's a thing that many people are unaware of, or at least they don't consider, especially in today's day and age, because of, historically bonds performed fairly well. But now in today's environment, because of the low interest rate environment that we're in, if you're buying bonds or you have bond holdings today, for example, you have that 10-year treasury that's yielding 1.1 or maybe sub 1%, and interest rates do go up, a handful of years later, but you still have a 10-year maturity period, or maybe 5 years of that 10 years left. If interest rates rise, the value of your bond goes down. So you actually have principal erosion when your bond and the par rate that's being the coupon on it is less than what the current interest rate environment is. So in order for you to sell that bond, you have to sell it for a loss. So it's called interest rate risk. And when you're in bonds, many people that are in bonds right now are setting themselves up for, pretty, potentially catastrophic event if interest rates do rise in, the next 5 to 10 years, and they're still holding those bonds, especially long-term bonds. They're really setting themselves up for a bad day. And then we have the last part of the pyramid, the base, and that is your conservative risk tolerance products, your CDs and money markets, your fixed annuities, and then your index annuities. Index annuities find themselves in the conservative portion of this pyramid because of the guarantees of the contract that state your principal's 100% protected from market loss, and you get a 0% guaranteed floor, meaning if the index that you're assigned to goes down or has a negative performance for any given period of time, you're just going to be credited a zero. You would not have a negative amount credited to your account, and which would reduce your principal and interest. It's designed to help you grow your assets with tax deferral and income-based performance. So the Power series of annuities offer growth potential through index interest accounts that may generate higher interest than CDs, treasuries, and other fixed income instruments. These fixed index annuities also offer the comfort and security of a 1-year fixed account with a guaranteed rate of interest. The power of tax deferral: with any taxable investment, you pay taxes on interest earned each year. With a Power Series index annuity, your earnings are not taxed until withdrawn, giving you the potential to accumulate more assets for retirement. Plus, once you begin withdrawals in retirement, you may be in a lower bracket, which could provide you with additional tax savings over time. And then it's all about the growth, right? We're looking at this for growth. We're looking at it for lifetime income. Let's hear about the growth. That's what I think everybody wants to know about. And so the power of index-based performance is using a index interest account linked to an index like the S&P 500. Although your assets are not invested directly in an index, a Power Series index annuity offers you the opportunity to earn interest based on whether the index is up or down at the end of an index term. For example, if you have a 1-year point-to-point crediting method and you're in the S&P 500 and let's say it has a 50% participation rate, if for that given year the index S&P 500 went up 10%, then they would multiply the 10% by your 50% participation rate, and your contract, your accumulation value, would be credited 5% of that growth. If it went down, maybe it was down 10%, you would just get credited a zero. If an index performance is positive, your annuity may increase in value. They're going to show us a graph here momentarily to show us. And then if the index performance is flat or down, your annuity value remains the same. Now, when it comes to allocating your assets in the annuity, you have many different options to do that. You have several different index options to be able to allocate your dollars amongst. You don't have to put all of your eggs in one basket, so you can diversify within the annuity itself. And that's where it's key working with a financial professional or an annuity expert like ourselves here at Annuity Association that really understand, the mechanics of each individual product. And because of the analysis and research that we do across the entire independent marketplace, we can show you exactly what these products will do by back testing the performance based on the parameters of the contract offered today. So we'll dive into that momentarily, but we'll take a look at how these products have performed over the last 10, 15, and 20 years to help you make an educated decision on if this is one you should consider or not. If you'd like assistance with doing that and working with myself, you can go to annuityassociation.com. Right on that main page, fill out the form, click the green button, and we'll get a report out to you, and we'll get in touch and see how we can help guide you in the right direction. So here they're showing an example of how the index annuity works when compared to the general S&P 500. So they're showing the S&P index has been positive 73% of the time over the last 30 years with an average annual return of 9.11%. So they're getting these numbers from 1990 to 2019. And then they're showing the chart of those years, and you'll see the blue years are all the positive years, and the orange are the downside years or the negative years. Now, obviously, when the negatives happen, even though they're not happening as often, they're somewhat large. If you notice 2008, the S&P was down 38% coming out of the global financial crisis. In a fixed indexed annuity, there's the slogan that we say is that, zero is your hero. You protect your principal with the power of zero. A Power Series indexed annuity offers you the confidence of knowing your money is protected against market downturns and that it can grow with no loss of principal due to market fluctuations. Keep in mind your contract value will be reduced by any withdrawals you take or any fees from any riders or options that we add to the annuity, maybe for lifetime income. No loss of earned interest. Any interest earned is locked into the contract and protected from future downturns. So that's really big. If you have 1 year where you grew 5% and you got that credited to your account, and the very next year the index went down 10%, well, keep in mind and rest assured that because of the guarantee of principal protection, all of your interest as well as your original principal is protected and locked in from any downturns. And there's no emotional ups and downs. The people we speak to that have a lower risk for the markets, they say every day they're logging in and checking their accounts and looking at their 401ks, and they saw this or that on social media or the news, and because of whatever was said on those mediums, that caused the markets to go down a few points. And that's not the way to live in retirement. There's a better way. I'm not saying that you need to pull all of your money out of the market, but use the tools you have available from a holistic approach perspective. And an indexed annuity, in most often cases, has a strong argument to be in your overall retirement portfolio because of the way the mechanics work and the principal protection it offers. It's a very suitable alternative to bonds. I mean, if you could get 4 or 5, 6% out of a fixed indexed annuity versus buying 10-year bonds at 1%, you tell me which is the better product to have. I would say the 5 or 6% versus the 1%. In addition, you're not exposed to interest rate risk in the indexed annuity, and you have a guarantee of 0% floor principal protection, so you can't lose any money. On a bond, if the interest rates rise, the value of your bonds go down and you erode principal because of that. So something to think about. So putting the power of zero to work for you, as the following hypothetical example shows, negative index performance over a 1-year crediting period like the S&P 500 index's 38% decline in 2008 would not affect the value of your Power Index annuity, Power Series indexed annuity. They're showing 38% annual decline in the index. You would have just gotten a zero, and that would have zero impact to your principal. Here's an interesting segment here. Could you afford a lost decade during your retirement? The lost decade is what many financial pundits have labeled the 10 years from 2000 to 2010, when key U.S. stock market indices posted either low or negative returns for the entire decade. If a Power Series index annuity had been available during the lost decade, based on the assumptions below, it would have protected your annuity's value from sharp market declines and provided growth over this time period. Please note that past performance is not a guarantee of future results. A Power Series index annuity would have provided principal protection and more interest than the S&P 500 over the lost decade. So here's a really cool example showing that if you owned this product during that 2000 to 2010, or what's referred to as the lost decade, how would your indexed annuity have performed versus being all in the S&P 500? So the blue line is the Power Series indexed annuity, and then the orange line is the S&P 500 index without dividends. So you'll notice during the downturns, in 2002 to 2003, and then in 2008, you're noticing really big drops on that orange line. But because of the guaranteed protections provided by the annuity, the blue line never has a valley. It never goes down. It just either stays flat during those down years and then rises up during the good years. And ending that 10-year period, the indexed annuity would have had a value of $136,097 versus $95,238 in the S&P. Both accounts starting with a $100,000 initial investment. So you would have lost $5,000 after 10 years in the S&P, or you could have made $36,000 and change on top of your $100,000 with the indexed annuity. So pretty neat stat there. Really tells a strong story. Now the guarantee income for life. So we're talking about the Power Select Plus indexed annuity, which is part of building lifetime income. It's the annuity that AIG offers for lifetime income focused intentions there. So it's called the Power Select Income, and it's about creating a retirement paycheck that you won't outlive. Every Power Series indexed annuity offers no-cost annuitization options, including guaranteed income that can last for your life or the lives of you and your spouse. If you're concerned about inflation or rising retirement costs, you may want to consider purchasing a Power Series indexed annuity with a guaranteed living benefit rider that provides guaranteed income for life, plus the opportunity for rising income in retirement. To receive this guarantee, withdrawals must be taken within the terms of the contract. Please see the corresponding GLB rider, which we'll dive into just momentarily. So there's going to be two ways that you can generate lifetime income using the Power Select Plus Income annuity. The first one is just getting the general GLB rider, which there is an annual fee for, which we'll be taking a look at momentarily to see how much that fee cost. Or you can annuitize your income, which basically is the word for converting whatever the accumulation value is whenever you go down the road in this annuity. Whatever your accumulation value is, you can call AIG and ask them how much they would convert the accumulation value into a lifetime income stream. The only problem with that, and it's not very common that that option is done, is that you do lose access to the principal and interest. You lose control over it. So once you annuitize, you're giving up access to your funds in exchange for lifetime income. Now, how that differs on the lifetime income rider is that when you elect for the rider, you still get the guaranteed lifetime income, but you also maintain control over the principal and interest, and that still has the opportunity to grow with the index growth. So you still maintain liquidity, you still have control over the money, and it allows you to really have increasing income potential if the index still performs. So when you're looking at a lifetime income annuity, most people today will go with the lifetime income rider. It's very rare that people annuitize their accumulation value. So I want to make sure I point that out. So for those not familiar with AIG, American International Group is a leading global insurance organization providing protection and financial solutions with approximately 46,000 employees, serving customers in more than 80 countries and jurisdictions around the globe, $525 billion in total assets, and nearly $50 billion in total revenues for 2019. Okay, so let's go ahead and break down this product real quick. We're going to look first at the index options that are available to see how we can grow our retirement nest egg safely. And then we're going to pivot over to the lifetime income to see what does that income look like and we'll use a hypothetical scenario on plugging some data in to see what that looks like. So let's go ahead and pull up our software and dive into this annuity. The first thing we're going to do is look at the historic returns of this product. So when we're breaking down the Power Select Plus Income, we're looking at it on the growth side first. So when you're looking at an indexed annuity, take a piece of paper and a pen and draw a T chart. Okay, just a letter T. On the left-hand side of the T chart, you're going to put accumulation value. On the right-hand side of the T chart, you're going to put income value. In an indexed annuity with lifetime income riders, you're going to have two moving parts, the accumulation value and the income value. Now, the index and the index strategies are what determines how the accumulation value grows over time. However the index performs, you multiply that by the participation rate or the cap rate or spread rate or whatever the current strategy is, and then that'll spit out the return on your money. On the lifetime income side, when you buy a lifetime income rider, essentially what you're doing is buying a contractual guarantee of growth on the income value. So the values move separately. They're not moving in tandem. They're moving separately. You have the income value moving by the guarantees of the rider contract. So, for example, many riders today will guarantee what's called a roll-up interest rate of anywhere from 6 to 8% every year compounded. So if you put 100,000 in and you're getting a 7,000 or 7% guaranteed roll-up rate, and you defer the income for 10 years. So let's say you're 55 and you buy this annuity with a 7% roll-up rate, and you don't need the income till 65. Well, each year that you're deferring that income stream, you're growing it by 7% compounded on the income side. When you turn it on, that 100,000 should have grown to about 200,000 based on the rule of 72, which says, if we have about a 7% interest rate, how long would it take to double your money? And it's going to be just over 10 years. So when you buy a lifetime income rider, you're buying a contractual interest rate that's guaranteed to grow no matter what the market does, no matter what the index does. So that's very important to note. But right now we're looking at just the growth side, and we're going to really break down which annuity index option for the Power Select Plus income is going to give us the highest opportunity for growth. And what we're doing is looking back over the last 10-year periods and how this annuity would have performed. And actually, let me go ahead and pull up a different part of our software here that'll give us more insight. Bear with me. Okay. What we're going to do is look at the hypothetical back-tested performance of the Power Select Plus, and it's going to show us the best 10, 15, and 20-year period returns or average returns for those periods of time. Bear with me. It's taken just a second to pull it up. Here we go. Okay. So Power Select Plus income, the top performing strategy found in this annuity when looking back over the last 10, 15, and 20 years is the 2-year Merrill Lynch Strategic Balanced Index. It's using a point-to-point strategy with a spread. And if we look at the 10-year period, we're looking at a 5.66% average annual credited interest rate that's compounded. If you look below that, you're going to see a green and red number. The green is showing us over the last 20-year periods what was the best 10-year period of those last 20 years. And in this case, it's July 22nd of 2002 to July 22nd of 2012. The highest 10-year performance was 7.21% annually, average credited interest. The worst 10-year period on the right in red is 4.34% from March of 08 to March of 2018. And then when we look at the last 15-year period from December of 05 to December of 2020, the average return was 5.14% annually. Last 20 years, 5.59%. So very strong figures there, very reasonable rates of return, significantly higher than bonds today, significantly higher than bank CDs today, significantly higher than money markets today. So consider, an indexed annuity. These are the power growth options that they offer. And you're doing so in a very conservative manner because of the guarantees of principal protection. Now, in addition to that, there's multiple other indexes offered inside the Power Select Plus income. The Merrill Lynch Strategic Balance 2-year point-to-point is going to show us the best performance when looking back over those periods of time. And so that's the one that I would consider looking at. If you're looking at buying this annuity, consider that Merrill Lynch Strategic Balanced Index. Just to take one more minute, we'll see how it performed last year to give us an idea. So last year, 2020, this is the pure index. This is not without this is without the parameters of the, participation rate and all of those things. This is just the index performance. And you can look this up. The ticker's MLSB. If you go to Google and type that in, you should be able to get the website for it. But last year for 2020, the Merrill Lynch Strategic Balanced Index performed 10.52% return. Very, very strong. 2019, it was 14.18. So it shows you the power these fixed indexed annuities can really offer. Today is all about income, though. So let's go ahead and pull up the guaranteed income calculator, and let's see how this annuity would stack up when giving us some income options. Let's look at a male, age 60, and we're going to assume that maybe he's retiring. Hypothetically, the scenario that he's retiring, age 67. So let's take a look at $100,000 premium investment, and then see if we can pull up that Power Select. Let's see if I can do that. Bear with me. Let's just put in AIG, get the rider name for it. Okay, here it is. So the Power Select income, it's called the Lifetime Income Plus Flex. Okay. I got to separate it for the rider just to get that one to pull up. Lifetime Income Plus. Okay, so what you're looking at here is our guaranteed income calculator. It's one of the value adds that working with us at Annuity Association we can help you with in determining which income annuity is going to provide the highest income depending on how long you're looking to defer it. Whether it be 2 years, 5 years, 7 years, 10 years, etc., we can help you pinpoint which annuity and which annuity company is going to offer you the best income guaranteed for life contractually by sorting it through this calculator. Again, go to annuityassociation.com if you'd like us to help you with that. So we're looking at, again, hypothetical situation. A male age 60 is buying this annuity today with the Lifetime Income Plus rider. He's putting in $100,000 and he's going to defer it to age 67, and that's when he's going to turn on the income. So he would be deferring it 7 years. So as I slide this bar up and down, we can determine 7 years right here. And then he'd be turning it on contract year 8 at age 67. Now, here is the guaranteed income on an annual basis on that $100,000. So $7,599. If you want to see what it looks like monthly, we can switch to monthly, and it's $633. Well, let's stick to annual for now. Now, let's break down how that annuity is growing on the income value side and how it's factoring to, give us that $7,599 figure. So when you're looking at the Lifetime Income Flex rider, which is the guaranteed lifetime benefit rider being added to the Power Select Plus income annuity, it's giving us a 7% simple roll-up interest rate. So it's taking that 100,000, multiplying it by 7% every year for 7 years, and that's getting us to a income value of 149,000, or what also is referred to as an income benefit base. So it's growing by 7% a year, simple interest, not compounded in this case. So it gets our income value up to 149,000. Then in each annuity contract, they have what's called a distribution rate or a payout rate. The payout rate in this case on this annuity is this highlighted number. It's 5.1%. That payout rate in many different annuities are different. They may pay out a slightly higher payout percentage every year that you age. Some are structured where it's every 5 years. If you're 60, and then by the time you're 65, if you turn the income on at 65, the payout rate may be like 50 basis points higher than if you were to turn it on at 60 or 61, 62. So in this case, let's look at that highlighted number, the 5.1, and go back on the deferral. Yep. So it's starting to go down. As we reduce the amount of years deferring the income to turn on, you'll notice that it went from 5.1 to 4.95, then to 4.65, 4.5, 4.35. So the longer you defer it, every year, that distribution rate or the payout rate increases, which ultimately increases your guaranteed income amount. If we go to 8 years, the income value goes up from 149 to 156, and then the payout rate goes from 5.1 to 5.25. So that's the logistics of income annuity that's deferred, is that you have a few different factors into the equation. You have your interest roll-up rate, you have your age, which is determining your payout rate or distribution rate, and then sometimes the annuities will offer a bonus. So you may have a bonus initially on the income value as well. In this case, there is no bonus on this particular product at this time. Now, let's look at, that's the fixed income option. They also have the, let's see if it's in here. Yep. They also have the option for increasing income, and they call it the lifetime income plus multiplier flex. That's a mouthful. And how this works is, instead of it having a guaranteed interest rate that's set in stone on the contract of the rider, in this case, on this rider, the lifetime multiplier flex uses the index growth side. So it uses your accumulation value. So if you remember that T chart, instead of it having a guaranteed roll-up rate on the income value, it's determining the income value based on how the accumulation value performs. And for example, over that 7 years of deferral, if the accumulation value grew on an average of, let's say, 5% a year, then what they do is they take 200% of the interest rate. So whatever the interest rate was for that period of time, on average, they're going to multiply it by 200%. So if it was 5%, it would be 10% is what would be credited to the income value. And then they factor that into the overall income amount and then multiply it by your distribution rate. And in this case, it's showing $5,100. Now it's showing that amount because it doesn't know, what this grew to. It doesn't know how the index performs, so it's leaving the 100,000 flat. And that's why it's just showing the 5,100. But let's see if we can illustrate this a little bit more accurately in a hypothetical manner. So again, we're going to use the same scenario, $100,000, 60 years old. Let's do this. See if we can find this lifetime income plus flex. It may not be in here. Bear with me. Let's find out. Yeah, they don't have it in here, unfortunately, so I can't really illustrate that. Let's see if I can do one more thing. But essentially what you're doing when you buy that opportunity for increasing income is you're only looking at the accumulation value at that point. So however it grows over a period of time, they're going to multiply the growth by 200% and then give you that credit towards your income value. And that's how your income value will grow. And then they factor in the multiplier of the distribution rate, and it works just like that. So one of the other things we can do, if you're interested in finding out more about how that increasing income opportunity works, we can put an illustration together directly from AIG. Just again, go to our website, annuityassociation.com, fill out the form, click the green button, and we'll get together with you on that. So that's going to wrap up our review today. I wish I could have illustrated that increasing income option, but unfortunately it's not built into our system just yet. It is still going through some beta testing, but I do want to say thank you for tuning in, and I hope that we were able to add some value to you today. If you have any other questions or you'd like assistance in comparing annuities, whether it be growth annuities, fixed indexed annuities with lifetime income, general lifetime income annuities, anything annuity, you can go to annuityassociation.com, fill out the request for a form, free report, and we'll get that out to you in a timely fashion. So thanks so much. Appreciate your time. Take care of one another. Have a good day.